Will the trade wars cause a market crash? Well, today we're going to talk about the art of the deal and Donald Trump. The threat is real in the art of the deal. Now, I'm going to cover a few things, including the original book that I read probably about 15 years ago called The Art of the Deal. And we're going to describe from what I learned in that book 15 or 20 years ago when I read it, how these negotiations are going to take place, at least according to history as we know it, in accordance to how Donald Trump has negotiated over the past. We're going to talk about how Donald Trump perceives winning in this particular case in the tariff wars with Canada, Mexico, China, and others, why we should expect some volatility and maybe even a market decline. And we'll talk about how to deal with that, because in every single situation, there are as many opportunities as there are downsides to any events in the market. And I am always looking for the next trade. So let's get started. Welcome to the Smart Money, Dumb Money Show. I'm your host, as usual, Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management. I've got some pretty interesting stuff to talk about and how the trade wars are going to be affecting us as Canadian investors. Well, I first want to cover some of the basic rules that Donald Trump covered in that book, The Art of the Deal, written so many years ago. And the main thing that I got out of that book is that Trump likes to capitalize on uncertainty. So let me just give you a quick story. My daughter phoned me last night and she was freaking out over how Trump is going to impact Canada and everything's going to be bad. And I said, you've got to understand, this is before I decided to do this video. I said, you got to understand that the way Trump works is he uses sort of a trading rule that has worked very, very well for him. And I'll go through the list and you can refer to my notes here as I check them off, but I'll kind of walk you through it. First of all, Trump thinks big, and that's most certainly what he's doing here, isn't it? He is thinking in terms of worldwide trade tariffs and trade balances. So his formula is kind of like this. He likes to break down the competition. And what that means is he wants to convince the person on the other side of the negotiating table that whatever they have isn't as good as they think it is. And if you're watching Trump right now in his negotiations recently with trade conversations with Mexico and Canada, he basically was using words like, well, we don't need their oil anyway, or we don't need their automaking anyway, or that kind of stuff. So that's part of his strategy, is he always makes the other side of the negotiating table think that we don't need you and you're not nearly as valuable to us as you think you are. Okay, it's part of the deal. And next thing is he likes to, as he called it, fight like hell. He will push for what he can get, and he trusts in himself through doing this for a very long time. And let's face it, the man has built up a fortune, starting off with a smaller inheritance from his father, and he basically turned it into a very large empire. So he does know how to deal, and you got to give him that. And he likes to, and this is the most important thing I want to underline here, is that he likes to, after telling you, you don't have anything I want, we're better than you, we don't need what you've got, all that kind of thing. And then he'll say, okay, let's give you some flexibility. Do you think that after he said to the president of Mexico, we are going to give you 30 days, do you think that it was any negotiating skill that our representatives brought to the table to get that same 30-day extension? Trump already knew ahead of time that he was going to give that 30-day extension. Just keep in mind, this is all according to the playbook. And that's why I kind of laughed when my daughter phoned in a panic and I said, this is the playbook. And so let me tell you why I'm not as worried, although there are some concerns. The first thing I want you to know is that tariffs by the US on Canada, Mexico, China, wherever, are just as inflationary to them as it is to us. So keep that in mind. And Trump's team is very aware of that. So it's a double-edged sword. So, in fact, I'm going to give you a quote here, and I want you to take a look at it right on the screen. So, this is from Wall Street Journal. Are they about reducing the flow of fentanyl, which is one of the things that the U.S. has been asking for, or is his real goal to rewrite the North American trade deal? And if that's the latter, there's more volatility ahead. And that's what I think. There's lots of volatility, but it's not necessarily doomsday. Still, you've got to be prepared because we're not in Kansas anymore, Dorothy. Like, we really have to take a different attitude towards how we're going to invest. And that's what I'm here to talk to you about. So that when we go back to that, one of his strategies, as I said, is that whatever the other side says they have that they think is good, make sure that they understand that it's not as good as they think. And you could call it, instead of the art of the deal, the art of the bluff. Because in the case of Canada, the oil exports to the United States represent 60% apparently of their usage. So in other words, we in Canada provide them with 60% of what they need in oil and gas. So it's a bit of a bluff on some of the things that we'll be looking at when these trade deals come across. Next thing we need to understand is that, there are certain things that the US really does want to get out of the deal, and you just have to understand what they want. And if you'll notice, when Canada and the US, or sorry, Canada and Mexico both got their extensions by 30 days on these tariff negotiations, it's because Canada and Mexico both quickly agreed to do what Trump wanted, which is what he wants out of the deal, which is why ultimately it's going to cause some volatility because he's a volatile personality. Is that a surprise to anyone? But he's also got some things in mind that he wants. So let's go to those things that he wants. What Trump wants is control of illegal immigration, and that's a biggie. And really, Canada has been at fault in that situation. So has Mexico. We've let a lot of people run across our borders here with absolutely no border control whatsoever. And that has caused a lot of both illegal immigrants and illegal immigrants of the wrong kind, often those associated with drugs and crime. So there is a lot of fentanyl entering the States. Apparently, Canada is actually not a big provider of it. Still, we are providing some of it. So we have to take responsibility for that. And he wants us to. And that's a fair shake. It's not outrageous for him to do that. In fact, that's why Daniel Smith, originally, when he went down, went down to visit with Trump, she right off the bat agreed with Trump that she would start to send drones over Alberta border and try to control the border. It's what he wanted, and he's made it very clear that that's what he's going to get. And that's a bottom line kind of thing. It's not a negotiable. Next thing is adjust trade deals in areas seen as unfair. Now you might think, oh no, we're fair all across the board. Well, actually, we're not. I'm using a CIBC U.S. bank account, and I can transfer money across the border back and forth in U.S. currencies and write checks and all that stuff, even though it's CIBC, it's a Canadian bank. We have TD Bank has done that, Bank of Nova Scotia. So we have banks that are doing a lot of business in the United States, and and yet as a reciprocal, we have. I mean, I don't know about you, but I've never seen a Bank of America on a corner of a Canadian city block. So there is Fidelity, and there's Merrill Lynch does some business in Canada, but it's much smaller scale than what the U.S. is receiving from Canada in Canadian business. So that's fair. That's fair that we should do something about that, make the borders more open to their business coming our way. The other thing is dairy, and I have a particular experience with this because I'm actually, if you go back in some of my older videos, take a look at the one I did with interview with Maxime Bernier. And I actually got to know Maxime over the years. And for a while there, when he was in the Conservative Party, I worked with him on a campaign he was running to get the leadership of the Conservatives. He never got it, but I learned a lot about him, and I got to know him. And one of the things he talked about was the dairy cartel. And I used to think that was kind of funny, but in reality, Canada does kind of have a dairy cartel. Like, there's something called a quota, and the Canadian farmers, if you've got a quota, you can produce milk and sell it to the various grocery stores and whatnot. But if you are an independent farmer, you don't have a quota, you can't sell it. Well, that cuts a lot of the competition out of the market, and prices are very controlled in that way. And that's like cornering the market. It was illegal, but for some reason in Canada, it's acceptable. And in fact, another interesting fact that they don't like to talk about a lot is that when the farmers have produced too much milk, they actually will dump it rather than say give it to the poor or something to control the prices. So this is it's not necessarily the farmers, but the production side of that industry. So what I'm saying is that Trump has pointed out a fact that we are not allowing independent dairy sell their product in Canada to become a competitive market. So we in Canada could actually buy a cheaper product, but they in the United States could sell it to us. And so, these are the things he's looking at as areas of concern, and we can't dismiss it. They're legit. He's also talked about steel, auto industry, and forestry. I won't go into all of them, but we have to listen because this is what he wants. And again, you're talking about. I saw a cartoon the other day of a samurai wrestlers, and one was Justin Trudeau, a little skinny guy, and Donald Trump being the size of a house. You don't, a Chihuahua should never pick a fight with a Great Dane. So that's effectively, we have to listen to what the big dog wants. And if they're reasonable, then we should comply. If they're not reasonable, then we don't. So I think that we have to understand what the other side wants before getting emotional about it. But I said in the end of this is when coming back to my daughter's conversation, I said at the end of the day that we will be complying simply because we have to. And there are areas that it's not been fair. So it's going to be probably resolved quicker than you think. And therefore the volatility, which is going to be big at first, but there'll be probably opportunities down the road. Let's just go to another chart here. This is U.S. trade balance by country, and you can see the trade balances. That meaning these countries selling more to the United States than the United States exports. China's the big one. We all know that. The EU, Mexico, who Trump's already had conversations with, Japan, Korea, and Canada. So you can see right up to India, like we're in the biggest 7 or so countries of exporting to the United States. And that's why we are actually being targeted. We export more than we import from the United States. Now, on the lower end, what's interesting is for investors, if we're looking at New Zealand, Brazil, and even maybe Israel, there's net imports from the United States. So there's going to be no trade war, no tariff problems in some of the countries out there. And in fact, Value Trend has taken a position in Brazil because of that. Well, not because of that. We like the chart and a few other things, but in effect, the idea of looking at countries that don't have high deficit trade balance deficit is probably a good idea as an alternative to your portfolio. So keeping in mind, there's a reason why we are being targeted. What I want to talk about next is, okay, all of this potential volatility coming out of the trade wars. Well, what does that mean to the markets? Well, I want you to take a look at a couple things. I'm a technical analyst, but still fundamentals matter to me just as much as technicals. And so I'm using some research done by Bloomberg. And what we're seeing here is a number of fundamental indicators like trailing PE, forward PE, the Schiller PE that I've talked about in some of these videos in the past, price to book, price to sales, Q ratio, all these market cap to GDP, all these different factors in the United States. And you can see this goes back to 1900s. If we zoom in 1900, you can see over time that there have been a few instances, the worst one being 1929, just before the crash, were the late 20s, I should say, were valuations on the whole, if we take all those different ratios we just looked at, we're at record highs, and here we are again. Okay, so the market is, from a fundamental perspective, inarguably expensive, and on a historic basis, on a fairly recent basis, it's expensive. U.S. stocks are not cheap. Well, that leaves the door open to any volatility created out of tariffs and whatnot. We have some volatility because of that situation. So let's take a look at a chart that I've shown on my videos before and in my blogs at valuetrend.ca. This is a long-term chart, again, going back to about 1900 of the Dow Jones Industrials. And you can see that the market's been in a bit of a trend channel. And here we are, we're at the top of that channel. No surprise, that kind of lines up with the valuations, doesn't it? So just keep that in mind. We're not a cheap market, and we're technically overbought, and we have been for a while. So with all that in mind, I think that there's going to be volatility on the market. And so what is my answer to volatility? Well, first of all, we can track it and we can find out when it's ending, okay? And we can also make predictions on how the market is going to be predictable, and I'll show you how to do that in a second. And then we have a strategy on how to trade. So let's look at that. So first, going to take a look at a couple of indicators that we can follow to track market volatility. First of all, this is the VIX, which is the premiums that options are assigned when trading on the options markets. And when premiums are high, it means investors experience or expecting to experience higher volatility because therefore they want greater premiums on their options. When investors expect lower volatility, premiums go down, and therefore the VIX goes down. So the VIX has been very low. You can see it moves between kind of low and high points, and you can see we've just come off of a very, very low point in volatility. In other words, things were really good for the past few years, weren't they? I mean, we were all making 20% on the S&P 500 during 23 and 24, and we were kind of in la-la land. Everything was wonderful. Well, guess what? Markets get volatile once in a while, over and over and over, and we haven't been in one of those volatility periods where we've reached the top of the market. So I want you to know that we're due. We're due for market volatility to pick up, and we have the reason for it. We have this tariff war. So we need to track this. And so long as volatility is rising, and if I erase a couple lines here, you can see volatility is rising right now. The VIX is not a smooth ride, but volatility has been picking up, and I expect it will continue to pick up. So with volatility, that means what? Well, to quote Trump when he talked about drilling, drill, baby, drill, the answer to volatility is trade, baby, trade. If you are expecting to buy and hold through this period, you've got to have a good constitution, because I'm telling you, it's going to be volatile. At least it's probably going to be volatile. And I, for one, am not a lover of buy and hold during periods of time like this. In fact, value trend recently just moved over 20%. I think we're about 21% cash. And a lot of the other holdings we have are things like gold and other defensive sectors. We are very well positioned because we expected this to come for many, many reasons. Now, if you want to learn more about how to trade in volatility and how to recognize the signs of a probable market correction, as we did when we raised that 20% just a week ago from me recording this, then go to my online trading course. It's really valuable. It's 35 years of my experience and in professional trading. I'm a professional portfolio manager, and I've been trading professionally for 35 years and probably about 5 years prior to that. So I've been doing this a very long time. I put it all into that course. So last pane is another way to track volatility. And again, in addition to the VIX, you're going to watch this for a level to be reached, and that will tell you that volatility as a factor is near its historic highs, and that's when we can start thinking that markets will return to normal. But if you notice, there's kind of a band again that the put to call ratio likes to move in. So this is a put to call ratio of puts versus calls. When markets are scared, they buy more puts than calls, and when markets are bullish, they buy more calls than puts. So what we're seeing now is that markets were very complacent, and you see how low the put to call ratio got. So everybody was buying calls versus not many people were buying puts. Why? Because nobody thought anything bad was going to happen. Well, suddenly we're seeing that something bad is about to happen. That is the tariff wars. Well, we have a ways to go. We're not even at 0.9. Typically, the put to call ratio at its high range is about 1.25. And we're nowhere near that. We're at something like 0.9. If we zoom in on the screen, you can see we're at, the other day when I was recording this, 0.93. You can see very often it reaches 1.25 or higher. And this is historic. In fact, I wrote a thesis to get my CMT on using the put to call ratio in combination with momentum indicators to time the market. And it actually is a pretty good market timer. When it's too low, things tend to reverse. When it's too high, things tend to reverse again. So this means that we are about to see, or very likely about to see, lots and lots of volatility. And again, I encourage you to take my trading course because it teaches you how to deal with that. I have written a number of books that you can refer to as well on trading. And also there's a series of videos that I've just done called Technical Analysis Basics. And we have been posting this on the YouTube station here, so you can access those. They'll give you the very, very basics of how to trade. And for more in-depth information, again, take the online course. But the YouTube videos are a good start for beginners to understand trading. The bottom line here, folks, is this, that the future ain't what it used to be, at least for the time being. You've got to trade, baby, trade. You've got to watch those volatility indicators because they'll tell you for how long you've got to continue trading, or at least have that mentality. And it'll also be interesting to see how Trump follows the art of the deal, and how at the end of the day, he'll get what he wants. We won't be as decimated as everybody is currently imagining, because human beings tend to be overly pessimistic at market inflection points and overly optimistic at market inflection points. And I'm looking at Canadians, especially, the calls I've been getting from my neighbors and my daughter the other night. I'm seeing the fear and I'm hearing the fear. And what that means is that's going to end pretty soon, because that's just the way human nature is. We're always wrong at the wrong time. So we have to use these charts, we have to use these indicators to tell us when is the time to invest. I hope this has given you some tools, and I do encourage you to read my blog at valuetrend.ca. It's free as well, and you'll get all kinds of more detailed charts and information on how to manage these uncertain times. Thanks for watching.